Are we there yet? It's a question not only reverberating from kids in the backseat of the car, but from investors across the country. This now official bear market is really starting to weigh on everybody's nerves, especially after 5 consecutive negative days in both the S&P 500 and the Dow. Unfortunately, we don't have a GPS and estimated time of arrival when it comes to bear markets. So finding our exact location on this bubble is pretty much impossible. But we can use signals learned from previous bear markets. This is the anatomy of a bubble, created originally by a professor from Hofstra University. I like this graph because it illustrates reversion to the mean being the gray dotted line that you see there. That gray line represents the fact that the average annual stock market return has been 10% for nearly a century. That gray line is why advisors are encouraging you to stay the course. You can see the long bull market buildup and the subsequent bear market crash. When we ask the question, are we there yet? We want to know if we are at the bottom, labeled despair. But check out the phrase before despair called capitulation. This is an interesting concept in finance. Capitulation is also called panic selling. It's when investors literally surrender. They throw in the towel and sell out, basically giving up on the market. Analysts are trying to decide if Friday and Monday sell-offs were a sign of capitulation. They are looking for steep declines in value along with high trading volume. It's during this phase that the weak hands or investors who lack conviction fall off, and the strong hands, those who are more risk tolerant, will stay for the long haul. The belief is this fundamental change of investors from a less risk tolerant group to a more risk tolerant group will eventually provide stability to the market. Of course, it's impossible to determine if we are at the bottom until we can look in the rear view mirror and actually see the rebound. One thing we have noticed from recent bear markets is that the rebound has been slightly faster. The last 3 bear markets in 2011, 2018, and 2020 just took 4 to 5 months to recover. Whether or not we will fall into an economic recession will impact how fast our market recovers. While the chance we will have an economic recession is rising, confidence is still fairly low that we will. Why? Well, by definition, a key aspect of an economic recession is unemployment. And with our tight labor market, that's unlikely to happen. Right now, we have 5 million more job openings than actual unemployed workers. Employers are struggling to recruit and retain enough staff. It seems unlikely that would revert to massive layoffs anytime soon. It bears repeating again. It's impossible to determine where we are in the bear market real time. There is definitely still runway for the market to fall, but we do know bear markets recover. There is an old expression that holds, you make most of your money in a bear market, you just don't realize it at the time. I know it's tempting to capitulate and surrender, but this is the exact time when bad emotional decisions are made. Wait for the recovery and then reevaluate your level of risk tolerance and adjust your portfolio. That's it for this week. This is Jeannie, the 401k lady.